Passive income is a dream for many. Imagine making money while you sleep, enjoying life without worrying about bills. Sounds great, right? But here's the shocking truth. 90% of people who try to generate passive income fail. That's right, most end up frustrated, broke, or both. Many believe that simply investing in stocks or real estate guarantees a steady cash flow. However, the reality is far more complex. For example, nearly 80% of retail investors lose money in the stock market over a 20-year period, according to a study by Dalbar. This shows just how challenging it can be to find true success in value investing. So why is passive income so hard to achieve? The truth is, it's not as simple as putting your money in a stock and forgetting about it. There are hidden costs, unpredictable market shifts, and emotional hurdles that can derail even the best strategies. In this article, we'll uncover the secrets behind passive income and value investing. You'll learn why the myth of set it and forget it is misleading, how to identify true value in investments, and what it really takes to build a sustainable income stream. Get ready for some eye-opening facts and strategies that can change how you think about investing for the long haul. Your journey to true passive income starts here. Chapter 1. The Passive Income Myth. Why set it and forget it rarely works. When people hear passive income, they think it means zero effort. But ask any seasoned investor, and they'll tell you that's a myth. Warren Buffett famously said, "Investing is simple, but not easy." In value investing, passive income is anything but automatic. Take dividend stocks, for example. They seem like a straightforward source of income, right? Yet, not all dividends are created equal. Some companies cut their dividends when times get tough. If you're not paying attention, your passive income can vanish overnight. This happened in 2008 when even big players slashed dividends during the financial crisis. Then there's portfolio maintenance. In value investing, you can't just buy a stock and forget it. Markets shift, companies evolve, and sometimes, what was undervalued yesterday is overpriced today. Studies show that regular portfolio check-ins increase returns. A simple rule? Check your holdings every quarter, even if it's only for a few minutes. Reinvesting dividends is another overlooked strategy. People often spend dividends, but reinvesting can speed up wealth growth. According to a Vanguard study, reinvesting dividends can boost total returns by 2–3% annually. That might not sound like much, but it's a game changer over time. Another key is compounding. Albert Einstein called compound interest the eighth wonder of the world. Yet, in passive income, compounding only works if you're consistent. Missing reinvestment opportunities slows growth. Set up automatic dividend reinvestment. It's a simple trick to keep compounding in your favor. Finally, remember that good passive income takes time. Patience is your best friend in value investing. Research from Dalbar shows that investors who constantly check or adjust their investments perform worse than those who trust their strategy and wait. The takeaway? Set it, but don't forget it entirely. Chapter 2. Hidden costs. The silent killers of your investments. Hidden costs can eat into your returns like termites. They're small, hard to notice, but incredibly damaging over time. Management fees, taxes, and inflation are three of the biggest culprits. Management fees are sneaky. Many people assume that if they're investing, they're doing all the work themselves. But if you're buying funds or ETFs, you're paying management fees, which are often 1–2% annually. That might seem small, but over 20 years, it can reduce your earnings by nearly 20%. That's money lost to someone else's pocket. Then there's inflation. The average inflation rate is around 3% annually, which doesn't seem like much. But over 20 years, that eats away 60% of the purchasing power of your money. If your investments aren't growing faster than inflation, your income is shrinking in real terms. And taxes. Most people underestimate how much taxes cut into their passive income. Dividends and capital gains are taxed differently in different countries, but on average, you're looking at around 15–20% in the US. That's a big chunk. Tax-efficient accounts, like IRAs or Roth IRAs, can help shield your investments from these costs. Use them. Opportunity costs are another silent killer. Investing in one thing means missing out on something else. If you're tied up in a value stock that isn't moving, you're missing out on growth in other areas. This is a hard one to spot, but it's real. Diversification helps spread this risk, so consider balancing growth stocks with your value picks. A surprising hidden cost? Emotional stress. Investors often overlook it, but stress can push you to make rash decisions that hurt your returns. In a study from the American Psychological Association, 72% of people admitted that money stress impacted their well-being. When you're in for the long term, learning to handle market dips calmly is a huge asset. Chapter 3. The Patience Premium. Waiting for wealth can be painful. Value investing requires patience, a lot of it. Buying undervalued stocks and waiting for them to rise isn't for the faint-hearted. It's not unusual for value stocks to take years to reach their true worth. In fact, value stocks often underperform for long stretches. According to a Morningstar study, there have been 5 to 10-year periods where value stocks lagged behind growth stocks. Staying patient during those times is tough but essential. Patience in value investing is about holding onto your investments, even when they seem to be underperforming. Imagine you bought Amazon in the early 2000s. Its price dropped from $107 to $7 after the dot-com crash. If you had sold out, you'd have missed one of the biggest stock gains in history. Behavioral studies show that people hate losing more than they like winning. This is known as loss aversion, and it's a major reason why many investors abandon value stocks too soon. But those who stick it out often see strong returns in the end. Benjamin Graham, known as the father of value investing, once said, "The investor's chief problem, and even his worst enemy, is likely to be himself." A strategy for handling the patience premium? Diversify your value investments. Hold a mix of companies from different sectors, so when one lags, another might outperform. Research shows that diversified portfolios reduce the pressure of seeing losses in any one area. It's also helpful to set a timeline before you buy a stock. If you know you'll hold it for at least 5-10 years, it's easier to resist the urge to sell in year 2 when things look bleak. Create a clear, long-term plan, so you're not making impulsive decisions during rough patches. Lastly, keep in mind that patience is rewarded. A study by Dimensional Fund Advisors found that stocks with low price-to-book ratios, a common metric in value investing, generally outperform over long periods, despite short-term volatility. The key is to stay the course. If you're finding this information valuable, don't forget to subscribe. We'll share more tips and insights to help you navigate the world of investing. Chapter 4. Beyond the numbers. The hard work behind finding true value. Finding a genuinely undervalued stock is like searching for treasure. It requires much more than just a low price. You need to dig deep to understand a company's true worth, which takes time and skill. Value investing legend Benjamin Graham once said, "Price is what you pay, value is what you get." But recognizing value isn't always straightforward. You can't just glance at a price-to-earnings (P/E) ratio and call it a day. Instead, you need to dive into the company's financials, revenue growth, debt levels, profit margins, and cash flow. Each one tells a part of the story. Take cash flow, for example. It's a strong indicator of a company's health. Positive cash flow shows a company can meet its financial obligations, reinvest, and reward shareholders. A study from McKinsey found that firms with consistent cash flow growth outperform their peers by up to 35% yearly. Another factor to look at is debt. Companies with high debt are risky, especially if the economy slows down. Research shows that companies with lower debt-to-equity ratios perform better in tough markets. Warren Buffett often avoids companies with excessive debt for this reason. Management quality is also critical. A great CEO can drive a company forward, while poor leadership can drag it down. Look at the leadership team's track record and ask, have they added value in past roles? Reading annual reports and investor letters can give insight into their priorities and focus. Economic moats are another concept introduced by Buffett. A moat is a competitive advantage that keeps competitors at bay, like a strong brand, unique technology, or network effects. Companies with moats tend to withstand downturns better and grow faster in good times. One of the best strategies for finding value is to buy during market downturns. It might seem scary, but a study by Fidelity found that investors who added to their portfolios during recessions earned higher returns in the following decade than those who didn't. When prices fall, quality stocks often go on sale, creating great buying opportunities. Lastly, diversify your value picks. Different sectors react differently to market shifts. By spreading investments across multiple industries, you can reduce risk while waiting for true value to shine. Chapter 5. When the market fights back, dealing with volatility and unpredictable returns. Volatility is a big challenge in value investing. Stocks can swing wildly, and even strong companies can see their shares drop unexpectedly. Managing this volatility is crucial for long-term success. One important strategy is setting a buy and hold mindset. A study by Vanguard found that holding stocks for 10+ years reduced the chance of negative returns by 95%. But holding is easier said than done. When prices fall, it's tempting to sell, but this is often a mistake. A way to handle this is by building a margin of safety. This idea, popularized by Benjamin Graham, means buying stocks at a discount to their intrinsic value. It gives you a buffer against market drops. For example, if a stock is worth $100, but you buy it at $70, you're less likely to see major losses if the price dips to $60 or $50. Dollar cost averaging, DCA, is another helpful tactic. With DCA, you invest a fixed amount regularly, regardless of price. This approach smooths out purchase prices over time, making it easier to handle volatility. Research shows that DCA reduces average investment costs over long periods. Avoid emotional trading. Market dips make people panic, leading to impulsive decisions. Behavioral finance studies show that investors who react emotionally to losses tend to underperform by around 2–3% annually. Remember that in value investing, short-term market swings don't usually reflect a company's true value. Another way to guard against volatility is to balance value stocks with bonds. Bonds provide steady income and reduce portfolio swings. A typical split might be 70% stocks and 30% bonds for younger investors, while retirees might opt for a more balanced approach. Vanguard data shows that balanced portfolios tend to outperform all stock portfolios in down markets. Lastly, consider focusing on dividend-paying stocks. Dividends can help offset price drops by providing regular income. During rough markets, this income stream can provide stability, as dividends tend to be more reliable than price growth.